Let's take a look at your market news now. Asian investors trod uneasily on Tuesday as concerns over trade and emerging markets dragged on confidence. The pound held on to gains after the European Union's chief Brexit negotiator's optimistic remarks. US President Donald Trump ramped up the China-US tariffs row late last week by threatening to tax all imports from the Asian giant, sending equities further into the red. While some investors are returning to pick up bargain stocks, the ongoing worry about a possible full-blown trade war between the world's two top economies is keeping a lid on prices. Hong Kong is now almost 20% down from its record touched in January, putting it close to a bear market, while Shanghai is at lows not seen since January 2016. The Nikkei did manage to pick up 1.3% to 22,664. The Hang Seng Index dipped 0.4% to close at 26,508, while China's composite was 0.2% down at 2,664. US stocks mostly edged higher on Monday, with the S&P 500 and Nasdaq rebounding to snap a four-day losing streak, although a drop in Apple kept gains in check. The Dow Jones Industrial Average fell 23 basis points to 25,857. The S&P 500 gained 0.2% to 2,877, and the Nasdaq Composite added 0.27% to end at 7,924. Let's find out what else is happening in the markets. We cross to the Johannesburg Stock Exchange. Arabile Gumede is standing by. Arabile, good afternoon. Over to you.
Yeah, good afternoon, Nzinga. Well, it's a negative day for the market, largely pushed down by the mining stocks by the seams of it, which are down around 2%. The overall market more than 1.5% to the negative rather as well today. But there is some slight improvement in the currency, around 15.10 or so against the US dollar. Let's unpack exactly what's happening across the world. Let's take a look at your European and local markets. Well, resource stocks, as you can tell, they're sitting down quite a bit, around 2.1% there. A big fall on that front. Exactly what's pushing the market? Let's chat to independent analyst Chris Gilmore, who joins me now. Chris, thank you so much for the time. It's seemingly a bad time. We had a big 9 days of rallying along, seems like an awful long time ago now. And it seems like the market has just come back. Was that too hard a rally and perhaps the market coming back now?
Yes, in part. I think it was. But what you've also seen, Arabile, is this move back to what's called risk off. In other words, you've got investors and speculators alike. They're more in tune with the developing world, okay? And we see on the news earlier that Donald Trump and chappie in North Korea, I can never remember his name.
Kim Jong-un.
Kim Jong-un, yes, are going to get together for a second summit. Yeah. And of course, that's all very good. It's all grist to the mill as far as the developed world is concerned. And in so doing, it moves attention away from the developing world, the emerging markets, and they start taking a bit of strain again. And South Africa's woes have been compounded, as we were discussing earlier, by the fact that the rand keeps on tanking. And unfortunately, we're not seeing the benefit of that very weak rand in pushing the market up. Normally we would, but I think one of the reasons we're not seeing so much of that is because of the inordinately large influence of Tencent and Naspers, and it's not doing so well.
Yeah, it becomes a fear then as to where the market goes this year. Yes, fine, perhaps just looking at it for the year, which it is slightly down on the year and still not being able to make it up or see any green for the whole year. One asks himself, one, where do you find value? Because obviously value, is not just for this year, but really is long term. Do you just continue to do the same things, or do we start becoming a little more worried about the markets now?
Well, in fact, one should have been worried about the market from the past 4 or 5 years, because if you actually look at inflation and you compare the equity market performance, it's barely kept up with inflation in the past 5 years. I mean, really, it's in fact, it's actually fallen behind slightly. Yeah. So you haven't beaten inflation in being in the market. Okay, you haven't beaten it by being in cash either. However, you should be doing an awful lot better in terms of these so-called risk assets like equity.
So where do you put the money? Where do you put the money?
Well, this is where you've got to grit your teeth and say, right, I'm taking a 5 or a 10-year view on South Africa Incorporated. And you look at some of our, we mentioned some of the banking stocks earlier. My former company, ABSA, you know, I mean, that's now sitting on about an 8% dividend yield. You know, it's not going to implode, it's not going to collapse, it's going to be there in 5 or 10 years' time. Maybe it'll have the same name, I don't know. But the banks, I think, are looking incredibly good value. Are they going to go down further from here? Maybe, they might. But I think we're getting to near the bottom. Retailers, it's not quite so apparent. I think they came off very, very high bases, and they've probably got some ways to go yet. Construction is dead, is absolutely flat on its back.
I had somebody actually say to me that if considering the amount of litigation that has gone on in the country over the last few years, if law firms were listed, that's definitely one to get into. But the defensive stocks have not helped out either. You know, you would have thought that the tobacco brands or the alcohol brands would certainly be ones to get into. Still nothing.
And you know, I went to the AVI presentation in the JSE yesterday, and it was a reasonable result, 6% up. One of the points they made was that the lipstick factor, the so-called lipstick factor, seems to have disappeared. You know, it's just not there anymore. In other words, people are not even going for the little luxuries anymore. And I think, to answer your question, I think the consumer is now so cash-strapped and is so flat on his and her or her back that they're not doing anything. And now that we're in recession, formally in recession, I'm not going to use the T word, so it's going to make life an awful lot harder. People are going to hold back. They're going to spend less and less and less. And it just gets you into a further downward spiral.
Is that T word, and for people who don't know, the T word is just technical. Is that technical recession just a scare tactic? Have we not really been in this for the last couple of years anyway?
If you look at GDP per capita over the past 5 years, it's been declining every year for the past 5 years. So that, to my mind, is as good a way of defining recession as anything. To use this word technical, all it means is that in technical terms, this second quarter was lower than the first quarter. But you know, in most countries in the world, they don't preface the word recession with the term technical. I think it's a thinly disguised ploy to make it seem to be, oh, well, you know, it's only a technical recession. It's a full-blown recession, and it's tough, and it's nasty, and it's going to take us quite a while to come out of it.
Yeah. We spoke about the rand, now around 15, 12 or so. It seems, however, we're not being able to, as you said, take advantage of that weakness in the rand in some aspects. It's not good on in other ways, but you know, when you take a look at oil now, which sits at just around $78 a barrel, it kind of hurts to think that, you know, at the end of this month we probably will get another fuel hike. So there's no abating that either.
No, you're right. And coming in on the radio, I heard it's going to be in excess of a rand per litre.
That probably makes up for last month too.
Yeah, exactly. So this is going to be tough, and it just adds to that burden that the consumer has got. So there really is no respite in sight. Coming back to your point about the rand and the market, given the fact that something like 70% of the all share index is accounted for by companies that are either listed offshore or are have got the bulk of their earnings coming in hard currencies. So therefore, this very weak rand should really be pushing it up. I said we have one reason why it's not happening because of 10-cent stroke Naspers. But I think what may happen, and if I look into the crystal ball into October sometime, if we get a change in outlook from Moody's, from stable to negative, God forbid we don't get a full-on downgrade. But if we get that, then I think that may push the currency even lower. Now, if that happens, I think there is every good chance that we will see the market going higher, purely on those factors that I mentioned.
Chris, let me just push you. 2.9% increase in manufacturing in the month of July. Perhaps some silver lining?
That's looking a bit better. And, you know, one of the problems I've always had over many years is I try and figure out what we actually produce. Other than motor cars, and yet the NAMSA figures the other day were not so wonderful. So it's interesting. One has to go in and dig into those figures to see what's actually being manufactured and exported. But that is actually a good figure, and it's a lot better than expected.
Fantastic. We're 2.9% in July 2018 compared to July 2017 there. Food and beverages contributing 1.5 percentage points, while motor vehicles, parts and accessories and other transport equipment also contributing a positive 0.6% there to that increase. So perhaps some silver lining to that GDP number we had seen a little bit earlier, 0.7% decline for the second quarter. That's where the buck stops this afternoon, and that is your markets. Chris Gilmore, independent analyst. That's a look at your markets. Nompu and Nzinga joining you right after this. Do stay tuned.